The basic accounting equation is a fundamental concept in accounting. It states that a company's assets are equal to the sum of its liabilities and equity. Assets are what a company owns, such as cash, inventory, or equipment. Liabilities are what a company owes to others, such as loans or accounts payable. Equity represents the owner's stake in the company. The expanded accounting equation builds upon the basic accounting equation by incorporating revenue and expenses. Revenue represents the income generated from a company's operations. Expenses are the costs incurred in generating that revenue. The expanded accounting equation shows how profits, calculated as revenue minus expenses, impact a company's equity. The expanded accounting equation helps to provide a more complete picture of a company's financial performance. It demonstrates how business operations, reflected in revenues and expenses, directly affect the company's overall financial position. Understanding both the basic accounting equation and expanded accounting equation is crucial for comprehending a company's financial statements. The tax accounting equation is a concept proposed to highlight how taxpayers might manipulate the accounting equation to minimize their tax obligations. The tax accounting equation can be expressed as assets plus expenses equals liabilities plus revenue. Alternatively, it can be rearranged to revenues minus expenses equals assets minus liabilities. While mathematically sound, this equation highlights how manipulating liabilities to make income appear as debt repayment can lead to tax evasion. For instance, a taxpayer might misclassify income as a loan to reduce their taxable income. This manipulation would decrease their reported revenue and increase their liabilities, giving the appearance of lower profits or even losses. However, this practice is a form of tax evasion which is illegal. It is important to distinguish between tax avoidance and tax evasion. Tax avoidance is the legal practice of minimizing tax liability by taking advantage of tax laws and regulations. This can include claiming eligible deductions, utilizing tax credits, or investing in tax-advantaged accounts. Tax evasion, on the other hand, is the illegal act of not paying taxes owed by using methods such as under-reporting income, inflating deductions, or hiding assets. Tax avoidance is acceptable as long as it operates within the bounds of the law. Tax evasion, however, is a serious offense with significant consequences. Understanding the difference between the two is crucial for ethical and legal financial behavior. Combating tax abuse requires a multi-pronged approach. Governments can strengthen tax laws by closing loopholes and clarifying ambiguous provisions. Enhancing enforcement through increased audits and investigations is also crucial. International cooperation can be improved to track cross-border tax avoidance schemes. Lastly, promoting taxpayer education can encourage voluntary compliance. Beyond legal measures, ethical considerations are also paramount. While tax avoidance is legal, aggressive tax avoidance can erode public trust and create an uneven playing field for businesses. Companies and individuals should strive for responsible tax practices that contribute fairly to the common good. Transparency and accountability are essential for a fair and sustainable tax system.